All right, everyone. We're going to go ahead and get started here. Welcome to Wealth Wednesday. Obviously, right now is a crazy time with the election going on and everything. And so I actually think the Wealth Wednesday that we're going to be talking about today, the topic of protecting against the unexpected, it fits in perfectly for what we're dealing with right now. If anybody, I'm sure emotions are high every which way with the election going on. If anybody's feeling themselves feeling their blood pressure going up, I highly recommend watching last week's Wealth Wednesday, where Tony went through the election and went through possible outcomes of the election, because I think it's powerful, especially at lowering that blood pressure. And all signs point at this point to a divided government. However that pans out, which again Tony talked about last week on last week's Wealth Wednesday, that's actually a good thing for your retirement, for the economy. Let me know if you guys can hear me right now. We'll do a technical check right away here, and then we'll go ahead and get started. So I'm going to share my screen then. Let me know if you can see the screen share as well, and we'll go ahead and get started. So I'll start, and as comments come through and you guys let me know. If for some reason there is an issue, we'll stop it and kind of re-go from there. So awesome. We're going to be talking today all about, protecting against the unexpected. 2020 has been a bit of a whirlwind year. Nobody could have predicted COVID striking at the beginning of this year. This election has obviously been a surprise for many, and I think we'll see this play out as we go along. And a lot of people look down negatively on this year, and for obvious reasons, right? Pandemic striking the world is not a good thing, but if we can find a silver lining, I think the silver lining here is that it gives us a reminder that the unexpected, things that have never happened before, surprises, will happen throughout our retirement. Many of you are going to spend 30 to 40 years potentially in retirement, and the world's going to look completely different 30 years from now than it will today. Different surprises, different events are going to come up that we have to protect against. And so that's what we're going to be talking about today. A couple of things we're going to be covering. We're going to be covering the 2 essential things you must have to achieve peace of mind in retirement. We're going to be talking about an innovative way your retirement plan can prepare for the unexpected that really wasn't possible just 20 years ago. And tongue-in-cheek, I put a crystal ball there as the icon for this, because at the end of the day, this isn't going to be any predicting, okay? How we plan for the unexpected is through planning. It's not predicting anything. No one could have predicted COVID this year, but we could have planned for it. And then finally, we're going to go over the 4 most important what-ifs your plan needs to overcome. Your plan needs to overcome to give you complete confidence in the next phase of your life. So the 2 essential things that you need to live a good life in retirement are, number 1, something that we talk about all the time here, okay? The financial side of things, making sure you're financially able to enter the next phase of your life. Okay, you've been saving and you've been putting money away for the last 30 to 40 years. And now you're going to spend 30 to 40 years in retirement. And so a big box that we need to check off, obviously, is making sure we're financially able to overcome these unexpected surprises. But number 2 is one that I don't think we talk as much about, but is just as important, if not more important. And that's the emotional side of things. Okay, we can have the financial side. We can see the numbers and we can check that box off that everything should be all right with our retirement. But oftentimes I see retirees getting into a cycle of worry that we'll talk about. And it's worrying about things that might come up in the future. So for instance, if Joe Biden becomes our president, what's going to happen to taxes? Is the economy going to get locked down? Are we going to see another financial crash? And it's these what ifs that play in your mind that strip you of your peace of mind. And so over the past 30 to 40 years, everything's been about saving for tomorrow. Okay, you've likely put your kids through school. You've raised a family. You've paid for your house. Okay, you've saved money that you're eventually going to use in retirement down the road. Okay, it's always been about tomorrow, and retirement is about today. Okay. There is no tomorrow. Okay. It's about having the peace of mind that you can live out the dreams that you've delayed for these years. And I think oftentimes we think about the emotional side and having that peace of mind while we're working. And then once we get to retirement, we get stuck in that cycle of worrying about the what ifs. And so we're going to talk about how you can get the emotional side, the emotional freedom from your retirement plan as well today. So, and this is exactly what I'm talking about. For the last 30 to 40 years, you've dreamed about these type of things. Okay. If you have grandkids, or just a family in general, spending more time with your family. Okay. You got to replace that 8 to 9 to 10 hour a day job. And so you've thought about all the hobbies that you have, all the things that you want to do, whether that's spending time with the family, whether that's traveling the world. Okay. Whether that's just sitting back and relaxing and not having to worry about dealing with your boss at work, whatever it might be. Okay. You've dreamed about this for 30 to 40 years, but how many actually achieve it? Okay. Again, so many people enter retirement and just begin this cycle of worry, wondering about what might come down the road that might hurt you in retirement, that might hurt your retirement. And so this is kind of the cycle that we're talking about. So COVID was a big one. Okay. And I'm sure everybody's sick of hearing about COVID, but I think it gives us a good example for this. So heartbreaking story at the beginning of this year, in the spring of this year. COVID-19, economy gets shut down, stock market plummets. Okay. And so if you were just on the cusp of retirement, or you retired maybe late last year, all of a sudden you hear these breaking stories. You hear about how bad everything is, how there might be a Great Depression. So we've lost 25% in the stock market, and that we might see 50 or 75% losses like we did in the Great Depression. And you start wondering these what ifs. Okay. What if we do see a Great Depression? Okay, that $1 million that I have saved up could turn into $250,000. It might ruin my retirement right from the start. Okay, what if this lockdown continues forever? What if what if we never get out of this lockdown? What if it's our life for the next year? Okay, you play all these what ifs, and these what ifs infect, like a virus, like COVID, infect the rest of your life. Okay, maybe you lost some sleep for it. If you're spending time with your family, are you present during that time, or are you worrying about what's going to happen to my finances? What's going to happen to my retirement plan? And this worry infects your hobbies. It infects your retirement. It affects your sleep. And then we start thinking about, okay, well, if I'm hearing right now that we're going to see a Great Depression from COVID, we've lost 25% in the stock market. If we're going to lose more, should I make a change? Should I get my money out of the stock market? Okay, and we know how bad that was, but so many retirees made that mistake because of this cycle of worry. So many what ifs, and they ended up making a change that ended up hurting them in the long run. And so this cycle of worry just continues. The next news story, we know that the news' job, what bleeds leads. It's to get eyeballs. And so the news is constantly going to be bringing things to the forefront. And it's typically not optimistic stories. It's typically pessimistic stories. And so we begin this cycle. And this cycle from an emotional side can just zap your retirement, zap your peace of mind. Okay. And so there are a lot of risks that we have to face as retirees. Okay. Running out of money. It's the number one risk for this generation that's entering retirement, understandably so. Living too long or passing away early. We'll talk about both of those. I mean, I'm not going to go through every one of these, but you can see there's plenty of things to worry about. There's never a shortage of things that can go wrong, especially when we're thinking about your money needing to provide you with safety and income for the next 30 to 40 years. Okay, so how can we defend against these risks? Okay, is there a way, or are we just doomed to continue with that cycle of worry? Well, here's the problem with our industry is that, we have a complete disconnect. Okay, so when we're meeting with prospective clients, oftentimes one of the first questions we ask is, can we see any retirement plan that's been built for you thus far? Okay, and sometimes there are no retirement plans. Majority of the time when we see somebody having a retirement plan built, we see something like this. And if this is confusing, I agree. Okay, I do this for I do this full time. I work with these numbers all day, and I'm getting lost in all of these numbers. Okay, I see a spreadsheet with a bunch of different columns, and if your eyes are glossing over, so are mine. Okay, one, I don't. This is a fine retirement plan. It looks like it built out a lot of different factors, but what most people focus on is this column over here. Okay, total portfolio, and you can see it ends up going up, and so when your eyes are glazing over as your financial advisor is trying to explain all these complicated things, okay, you look over to this right side, it's like, oh, okay, well, it's going up, looks like a good retirement plan. But then what happens when you get home? Okay, when you get home, you get some separation, you get to think about it. It's like, well, what were the assumptions in this plan? Okay, what they obviously used a tax rate. What if that tax rate goes up? They obviously use the growth rate. What if that growth rate isn't as they planned in their retirement? And so in this plan, for instance, I believe the growth rate is just a static expected 6%. Okay, so when you get home and you start thinking about this, you go, well, what if my investment portfolio doesn't steadily grow by 6% per year like that plan said it would? What if it's only 5%? What happens then? And you haven't seen that example of it growing at a different rate. So that what happens when we're asking those what ifs? It typically goes pessimistic. Okay, if it only grows by 5%, am I in trouble? What happens if taxes rise by 10%? Oh, let me back up for a second. For one thing, a static 6%, just assuming your investments grow by 6% every year, I guarantee, unless there's some mystical CD out there that I don't know about, your investment portfolio will not grow statically at 6%. Okay, it might go up 10% one year and then down 5% the next, or up 20% and then down 30%. Okay, it's not static. Okay, and then you ask, what if taxes rise by 10%? We saw in this plan that taxes were taken out, great, but what if taxes change? Okay, what if Social Security is cut? You start asking these what ifs, and all of a sudden at every what if, at every turn in the road, this entire plan gets rendered useless. Okay, unless these assumptions play out perfectly, what's the point of the plan, right? So I kind of want to take you through a thought experiment. Hopefully this comes across clear. And what I want you to do is imagine right now that there is a 20-sided dice in front of you. Okay, and this dice is going to determine how successful your retirement is. Okay, and I'm going to let you roll this dice a couple different times. First, we're going to roll this dice in what I call a practice period. Okay, where you're going to be able to roll it as many times as you want, and then you're going to roll it you're going to go live and roll it. And so that live roll will determine how successful your retirement is. You get one roll when we go live. Okay, so here are the rules. You get a 20-sided dice, but you don't know what's on any of the 20 sides. So it's 1 through 20, but you don't know if all sides have 15 on them. You don't know if 5 sides have a 1 on them, and 15 sides have a 13 on them. You don't know what any of the sides are. It could be any combination. Okay, but here's the thing: if you roll a 10 or higher, your retirement plan is successful. Okay, so you practice round where you get to roll as many times as you want, and then you get to roll live. Or if you're not happy with what happened in the practice round, you can delay retirement, continue working, and roll it sometime down the road. So, question for you: in that practice round, okay, again, you don't know any of what any of the 20 sides are, and you need a 10 or higher. In that practice round, how many times would you roll that dice? Would you roll it once? Okay, so let's say we rolled it once and a 12 came up. Okay, would you be confident enough to go, okay, I don't know what's on any of the other 19 sides, but let's go ahead and roll it live. Okay, I see a 12. 12's a good number. Let's roll it live. No, of course not, right? You would roll that dice as many times as you could. You roll it 1,000 times, 10,000 times in that practice round, right? Because if we saw during those 10,000 rolls, if we saw 9,950 of those rolls were above 10, we'd feel pretty confident rolling for the fate of our retirement, right? Versus if we rolled and only 50 of those were above 10, we probably want to continue working. Well, what's interesting is this is basically rolling once is basically what our industry does. Okay, they build one retirement plan with one level of assumptions, and so they roll once. Oh, the retirement plan looks good. You have money at the end. You rolled above a 10, and so good luck. Let's start retirement. This is ridiculous, right? What we should be doing is rolling 1,000 times, rolling 10,000 times. And if you've ever watched any of our content before, you know that when we build retirement plans, we run that retirement plan under 1,000 simulations. Okay, and we're changing all these different variables in those simulations. So some simulations are with the stock market and investments doing relatively poorly. Some are with them doing great. Okay, taxes are changed throughout here. And so it gives us a number that we call the probability of success. And so in this scenario, out of 1,000 rolls, out of 1,000 trials, 670 were successful. Now, do you think that offers a little bit different information than just seeing this? Okay, would you have a little bit more confidence that you're prepared for the unexpected? Well, we're going to take this a couple steps further. But furthermore, rather than seeing some kind of just spreadsheet that we don't really get that much information out of this. Okay, we show clients something like this, and visualizing your income is powerful. Okay, so on the screen right here, you can see this orange line is your income, and so notice this income goes up here and then shoots back down. The reason being is because this person is going from COBRA insurance as they retired before 65. And then they're entering Medicare. And so their Medicare costs are going down because Medicare is a little bit more preferred. And you can see here later where it goes down is that one of the spouses is passing away. But notice here that the income is going up throughout retirement. That's because of rising costs. So every year things get more expensive. Our grocery bill goes up, okay? Cost of vehicle maintenance goes up. All of these different things go up. And so your income needs raises throughout retirement. Well, just looking at the screen quickly, we can see it offers a lot more information. So for instance, here we know, okay, this light blue we see is portfolio withdrawal. So at the beginning of our retirement, the majority of our money is going to be coming from portfolio withdrawals. Then once we turn on Social Security, we see how much of our income is coming from Social Security. So right off the bat, it kind of gives us a little bit of an indication what we should worry about or what we should plan for. Majority of the information or majority of the income coming from Social Security. So we should probably run a test to see what happens if Social Security gets cut. How does that affect my retirement? Okay, but either way, you get loads more of information. Okay, a lot more than something like this. And so we're going to go one step further for the rest of this presentation and do something that we call stress testing. Okay, now stress testing wasn't possible 20 years ago. Simply from, even the analysis we've already showed of running 1,000 simulations of your retirement plan wasn't possible just 20 years ago. Technology has improved leaps and bounds in the last 20 years. Now, unfortunately, in our industry, I see so many advisors still living in the 90s, planning for their clients in the 90s, and I think it does the clients a disservice. Okay, and so what we're going to talk about is something we call stress testing. And so on top of those 1,000 scenarios, we want to put stress on your plan. Okay, we want to ask questions like, what happens if you live longer? What happens if taxes rise? What happens if investment returns aren't as good as we thought they were going to be? Okay, and in every other industry, stress testing is commonplace. So for instance, civil engineers that are building bridges that span across rivers, okay, they're stress testing these bridges. So what would happen if we had, if the bridge was filled with heavy buses or heavy vehicles? What happens if we see hurricane force winds? How does the bridge stand up? Okay, if we have an earthquake, how will that bridge handle that earthquake? And so we stress test these bridges to make sure no matter what happens in the life of this bridge, that the people driving across this bridge are safe. Why aren't we doing the same thing with your retirement plan? Well, Here's a little bit of a snapshot of what this looks like. So we just showed normal probability of success. And so let's say we have an example where the probability of success is 93%. And so there's so many what if questions that invariably we will ask throughout our retirement. Big one is, what happens if one of us, talking about of a couple in a spouse, or of a couple, what happens if one of us lives to 100? Okay, what happens if they live longer than we think? That's great, but it also puts more stress on your plan. So here we can answer that question. Okay, we see that we go from a 93 to an 87. Well, why? Because we have to provide that many more years of income. And so that puts some stress on the plan. But what if my investments don't grow by as much as I think they will? Okay, well, we can put that into the plan. We can do that. And so if our investments perform just 1% worse than we thought, it goes from a 93 to an 82. What happens if one of us goes into a nursing home? On average, 50% of people will end up in a nursing home, and a nursing home can cost up to $80,000 a year, and they'll spend an average of 2 years. So that's $160,000 liability. Well, $160,000 liability by the end of this person's retirement, and they go from a 93 to an 88. What happens if the economy crashes after the election? Hey, again, we can test that, 93 to an 86. And so what's the alternative of not stress testing? You're going to still be asking these questions. You're just not going to have the answers. And so you're going to begin that cycle of worry. Okay, it's going to infect the peace of mind that when you're spending time with your grandchildren, when you're spending time in your hobbies, fishing, or spending time out on the boat. Okay, these are going to affect you if you don't have the answer. Now, in this scenario, every one of these stress tests left them in a pretty good position. So now this client, for instance, has a renewed sense of security that they're going to be all right. Okay, that's powerful. And so we're going to talk rest of this presentation. We're going to talk about the 4 most important stress tests that you need to run on your retirement. Okay, the first one is longevity. Okay, so on the right side of the screen, we have the probability of a 65-year-old living to different ages. And so a male has a 50% chance of living to 87, female 50% chance of living to 89. And if you're in a married couple, it's a 50% chance one of you will live to 92. Okay. And so how long right now does your retirement plan last? This is the big $1 million question in retirement planning. Okay. If we knew that the male in the couple was going to live to 82 and the female was going to live to 87, things would get a lot easier, right? We can make sure that you bounce your last check. Okay. If that was your goal, things would be easy. Things would be clear, but unfortunately that's not the case. So how long does your plan last? Here's the thing. People are retiring earlier than ever before, but they're also living longer than ever before. And on top of that, over the next 20 and 30 years, what kind of medical breakthroughs might we see? Okay. We've obviously had some significant medical breakthroughs in the last 20 to 30 years. If we were to find a cure for cancer, do you think that would change longevity? Of course it would. And so our plans need to account for that. We need to put this under a stress test. And so there's two real risks here. The first is living longer. Okay, that's a pretty simple one. But one thing that most people don't think about is passing away sooner. So when does that come about? Well, let's say that you have one person in your couple was the breadwinner, maybe has a pension through work, has the bigger Social Security value. Okay, well, if they pass away and you didn't pick a joint option for that pension, for instance, that pension might be gone. Well, if that pension was going to be a significant amount of your income, that person passing away could actually put more stress on your plan than that person living longer, because you lose out on the pension. Now, the Social Security value, one of them will pass to you, whether it be yours or theirs. If theirs is higher, the higher benefit will be passed to you. But passing away sooner can also be a risk that we need to factor in. And longevity is important to think about first, because it's the multiplier of every other risk. Okay, if you live 5 years longer than your plan expected, you're likely to face another market downturn or another economic downturn. Okay, the longer you live, the more your income will have to have raises each year because of rising costs. Okay, the longer you live, the longer there is a timeline that Congress could raise taxes, the government could raise taxes. And so it's the amplifier of all other risks. And so if we just look at this plan built out, so we have Bill living to 92, Kathy living to 94. Okay, we put them through a longevity questionnaire, and basically this is what the program estimated their longevity would be. So this is with no changes. They have a 94% probability of success. So what happens if we go in and mess with these numbers? We stress test these numbers. Well, let's say Bill dies early at 76 instead of 92. Okay, well, in this situation, Bill did have a pension that he had taken the life-only option on, so nothing would pass to Kathy. Well, in this scenario, they go from a 94 to a 90%. Now, that's not a huge deal, but again, it's good to know, okay? And it's good to plan for and have that in your back pocket so you're not worrying about what happens. And Kathy's all right, okay? With a 90% probability, if Bill passes away early, she'll still be all right, okay? And for Bill, that's a huge relief because sure, Bill will be gone, but he still cares about the well-being of Kathy, obviously, right? And so let's say Kathy lives longer. So rather than living to 94, she lives to 100. So again, this puts stress on the plan, but in this situation, luckily the plan was built well enough. They go from a 94 to an 89. Okay, but without these numbers, we just don't know how they'll play out, right? And so we enter into that cycle of worry. So question for you. This is something that we talked about in a webinar that we hosted. I believe maybe it was the end of spring or maybe the beginning of summer. And we asked the question, what's more detrimental to your retirement? A 30% stock market decline or taxes rising by 10% and inflation rising by 1% per year? Yeah. And so most people focus on the first one, okay? What happens if the election doesn't go the way I want and we see a 30% stock market decline? Or what happens if things get locked down? But actually, statistically speaking, for most people, taxes rising by 10% and inflation rising by 1% is a bigger risk to your retirement. The second one, however, is more of a silent wealth destroyer, where the first one is in your face. So we need to be testing for both of these situations, or all three of these situations, I should say. Question for you is, where is the majority of your wealth located right now? I'm guessing for majority of people on this call, it's in tax deferred accounts, things like IRAs, 401ks, and this makes sense. Okay, you got tax deductions, you got employer matches, and so this is likely grown into the biggest part of your portfolio. The problem here is that you got a tax deduction when you put that money in, and now you have to pay taxes when it comes out. And so if you have $1 million in your 401k right now, you really don't have $1 million. You have $1 million minus whatever taxes need to come out. And so if they raise taxes, it's effectively eliminating wealth the same way a stock market crash would. And I believe a tax hike is on the horizon. 2026, right now, the Tax Cuts and Jobs Act is set to expire. We'll talk about that in a second. But number two, just with how out of control our national debt has gotten, I think at some point Congress and the government is going to have to deal with that. And I think it's going to come in the way of taxes. But it's important to remember that a loss is a loss. So whether that loss is an investment loss or whether it's a tax loss, you're still losing money either way. A dollar loss to taxes is as bad as a dollar loss to the stock market going down. Okay, we need to constantly be remembering that. And so here's a situation that we put this client's plan under the stress test. So on the left right here, you see the Tax Cuts and Jobs Act. So we've talked about this at length, but basically this is set to expire in 2026. Basically what it's going to do is it's going to raise taxes. So we're going to go from the new law, which is the Tax Cuts and Jobs Act. We're going to go back to the pre-existing law, and it's going to raise about each tax bracket by about 3% per year, or 3% total. And so again, this is set to expire in 2026. Right now, we have to go with the assumption that these tax cuts are going to expire. And so we had a prospective client walk in, and we ran their plan based on their advisor's current plan. Okay, and based on the advisor's current plan, they weren't factoring in the Tax Cuts and Jobs Act expiring, and their probability of success was a 77%. Okay, now once we took out the Tax Cuts and Jobs Act in 2026, their score dropped 7%, just like that, just because tax is going up. Right? It's a small tax hike, as you can see, just about 3% across the board, but it had a big impact for this client's situation. Now, they would have never seen this in the previous advisor's plan because the previous advisor's plan was built under one assumption. And so then we tested it under the taxes rising by 10%, and they went from a 77 to a 48. Okay, they had a bunch of their money in tax deferred accounts, and so taxes rising by 10% eliminated significant amount of wealth. Just like that, just like a market crash would. Again, a loss is a loss, whether it's an investment loss or a tax loss. Okay, so Christy, do you expect everyone's taxes to go up or just on the wealthy? That's a great question. Tony talked about it last week. Right now, most of potentially President Biden's tax plan is to raise on the wealthy. Now, the Tax Cuts and Jobs Act expiring raises taxes across the board. I'm not sure in the future where the tax climate will be. Okay, I don't know if to deal with this national debt situation, that's going to just be raising taxes on the uber wealthy, or if that's going to be across the board. I don't think raising taxes on the uber wealthy is going to be enough. So it's more likely to be across the board. Okay. And so, yeah, and Tony just mentioned, depends on the Senate too. Yeah. So again, if we see a President Biden, if he gets elected and the Senate goes Republican, very likely that we don't see any big changes because again, 3 branches of government, you need all of Congress and the president to agree for something to go into law. So if they don't have the Senate, it's very unlikely they'll get anything major passed through. So number 3 would be rising costs. Okay. So here's the thing, just like you've got income raises throughout your working career, income raises in retirement are just as critical. Reason being is because each and every year things are rising in cost because of inflation. So if we compare to 1980 to today, cost of a car is $7,000, average cost. Today it's almost $38,000. Okay. Gallon of gas is not as bad as it was a couple of years ago. But nonetheless, rising. Same thing with groceries, same thing with housing, okay, across the board. And this is really the silent destroyer of wealth. And the reason being is because it doesn't show up on your statement each and every year. Okay, it's little by little, but when we zoom out, we can see how big of an impact it has. And once again, a loss is a loss, whether that loss is an investment loss or an inflation loss. Okay. And so here's kind of a snapshot of looking at different inflation numbers. So let's say that you need $70,000 of income today. Okay. Well, how much will we need 20 years from now? Well, if we see 2% inflation, which is basically what we've seen over the last 20 years, and it's been abnormally low, partially because interest rates have been low and whatnot, but $70,000 at 2% inflation in 20 years, you'll need $104,000 to have the same amount of income. Okay, if we raise that inflation just 1%, all of a sudden we need almost $20,000 more a year. Okay, if we raise that inflation 1% more, now I don't think we're going to see 4% inflation for the next 20 years, but it's not out of the question. We have seen it in the past. That $70,000 that you need will have to turn into $153,000, more than double. Okay, and that's just 4% for 20 years. And so this is a huge risk that we need to be thinking about stress testing under. And so again, we take that same 94% number, we go to the inflation module, and now normally we build plans at 2.25% inflation. Okay, well, historically speaking, if we go back over the last century, inflation has been 3.5%. Okay, and so if we stress test that plan at 3.5% inflation, this person goes from a 94 to a 65. So now we can start to see how big of an issue taxes and inflation can be on destroying your wealth. Okay, again, this is something that we want to test every plan under. Okay, And then finally, investment losses or lower returns. So right now is a very unique time in history. We are at historically low interest rates. Okay, before in the past, if we go back 30 or 40 years, you could put your money in a bond and you could earn 5, 6, 7% on your money. And so when you talk about a 60-40 portfolio of 60% stocks, 40% bonds, okay, that 6-7% interest rate that you can get from a bond, okay, compared to today where bonds are less than 1%, we are looking at two totally different growth environments. Okay, we can't assume that we're going to have the same growth on portfolios when interest rates are this low. And on top of that, the economic uncertainty. And so many people are throwing their bonds away, which I think is a good idea on average, depending on the situation, and moving their money into the riskier stock market. Now that has its own set of risks, right? The economic uncertainty. How will this election play out? How will all of these things play out? How will COVID play out? Will we see another decline? And we need to ask the question, how much does your plan currently rely on performance? Okay, or does your plan need to have a certain growth rate in order for your retirement to be successful? Okay. This is one of the simpler fixes, though, I will say, if you understand how this affects your plan. And so again, this keeps coming back to knowledge is power. These aren't things that we're showing you the risks so that at least you know the risks and so at least you're worrying about real risks. No, we need to know the risks so we can defend against those risks. We can build your plan to make sure that we curb how much those unexpected risks can hurt your plan. And so here's kind of a snapshot at the beginning of the year. I don't put a ton of stock into this. This is basically at the beginning of the year, a bunch of PhDs and investment companies put out their 10-year forward-looking returns. And the big thing is just across the board, everyone's expecting lower returns over the next decade. This makes sense with bonds as low as they are, with the uncertainty in the stock market across the board. Now, I'm not saying you should take this as gospel or anything. I'm just saying that there's plenty of people out there that think we're going to see lower returns in the future. And so if you're building your plan as if we're sitting in the 1980s, there's going to be a disconnect down the road, okay? And you don't want to realize that disconnect when it's too late. Okay, so on top of that, so that's the lower returns part. The investment losses is on average, there's about one correction per year. Now they define a correction in this as a 15% loss or more. So that average correction is about 15.6%. Lasts for 71 days. And so basically we can expect on average a 15% decline each and every year. And so are you prepared for that? Okay, are you emotionally prepared? And are you confident enough in your retirement plan that you know, even when we see that annual decline in stocks, that you're going to be all right? Because if not, it's going to be a roller coaster ride of emotion each and every year in retirement. And that's really going to zap the whole purpose of retirement, right? And so when we look at this, again, in this example, we're using a different person. They have an 85% probability of success. Now, they had a lot of their money in the stock market. Now, that had been great while they were accumulating money, but once they enter retirement, those losses have a totally different meaning. So they go from an 85 to a 49. Now, notice that's just at a 21% decline down here, okay? And so next, let's look at the lower returns. Same 85% probability of success. If their growth in their portfolio is just 1% less throughout their retirement, they go from an 85 to a 61. And so this person is relying quite a bit on the performance of their investments. And so what can we do? Well, we can maximize Social Security if we haven't already. We can cut investment fees. We can cut taxes. All of these things help. They all feed together, okay? Cutting taxes allows you to take less from your retirement portfolio, which allows you to rely less on your investment performance, okay? But the important thing here, again, is knowledge is power. And so everyone's stress testing will look different. Okay, it'll look different depending on your situation. There might be different stress tests that we run, okay? If you have a lot of company stock or options, that's something that we feed into your stress testing. A conservative investor will look different than an aggressive investor. The first will likely have their stress test issue will likely be inflation. The latter will be investment losses. Okay, a retiree with large tax balances or tax deferral balances will have tax risks that we want to stress test under. But really, the question that we need to discuss between your advisor and you is, what do you find yourself worried about the most? So there's likely a worry that keeps coming up, that keeps zapping that peace of mind from your retirement or from your future retirement. What do you find yourself worried about? Almost all of the time we can test it and we can give you a mathematical, data-driven analysis of that, of if you should be worried about that and what we can do to curb that worry. Okay. And so again, it comes back to first making sure that financially you're all right. But then really what stress testing does, I think, is give you that second point, the emotional freedom. Okay. That you can enter into retirement and know, look, the world's going to look different 30 years from now. Okay. We're going to see a lot of different risks. Some are going to be unexpected. Some are going to come out of the blue that we've never seen before. COVID, again, great example of this. But knowing that your plan is built for those surprises so that you're not surprised, worrying, and taking really the purpose of retirement away. Because at the end of the day, what's the point of going from a job where you worked 8 hours a day to entering retirement where you're worrying 24 hours a day? It just doesn't make sense. And so we need to make sure that you have both of these things. And so if you're worried right now about the election, about what's going to happen to the stock market, about any number of things, let us know. Okay. We can stress test your portfolio. Go ahead and comment below stress test if this is something you want us to do, or go ahead and private message either Tony or I. Okay. So just summary quick. Is your plan built for the modern times? Okay. Or is your plan living in the 90s? Okay. Technology has made leaps and bounds, and there are new things that we can do to help build a stronger retirement plan and alleviate the stress that you might have. We can expect the unexpected. Okay, I think this year's a great reminder of that. And I'm not saying we can predict it. Tony or I don't have a magic ball, but we can plan for it. Okay, we had clients that retired through COVID or retired right at the beginning of COVID, and had complete peace of mind as the stock market fell because their retirement didn't depend on that. So how much peace of mind would you gain from what we've shared today? Okay, just a question to think about. Okay, and always remember, guys, you don't need more money. You need a better plan. You need a better plan to eliminate the stressors, to give you that peace of mind. Okay, again, you've spent so long thinking about this goal of retirement, those long days when you worked at your job that you were thinking about retirement. Now is not the time to cross over into retirement and trade those 8 hours a day for 24 hours of worry. Okay, there are things we can do to give you that emotional freedom. And again, it just comes down to building a better plan. Thanks for watching Thanks for watching, everyone. Hopefully you learned some new things. Hopefully this fit into the climate that we're dealing with right now with this election craziness. Everyone stay safe out there. Thanks for watching. We'll see you next time on Next Wealth Wednesday. Have a good one.